future, banks will become technology companies with banking license, proclaimed Ravneet Gill, the chief executive officer of Yes Bank, amidst news reports that Yes Bank is looking to bring in a fresh investor and particularly technology investor. In fact, the very fact that the bank is looking to rope in technology investor is being touted as a huge dose of affirmation to retail investors who are panicking. This capital will be transformational capital, essentially meaning that capital which also brings specific capabilities with it. In his statement, essentially Ravneet hints at future of banking, a very popular trend in which banks are essentially partnering or also inviting technology companies to take ownership in banks to address the challenges of the banking sector. Technology will be able to revolutionize banking the way it has done with urban transportation, retail, commerce, to name a few. It is really based on the assumption that technology will herald new growth in the banking space. The problem with that assumption really is the underlying variables in that equation, which really is bringing in technology or transformational capital, explosive growth, and mitigating risk and challenges. They all follow a linear fashion. Unfortunately, world is much more non-linear than we tend to believe. In fact, the famed author Nassim Nicholas Taleb in his book Black Swan talks about the fact that non-linear relationships are ubiquitous in life, linear relationships are truly exceptional. Coming back to banking and financial services space, it really becomes a question now that can technology be the panacea for all the woes of Yes Bank, or perhaps by extension, the woes of the Indian banking space? One does not really know. Technology can really solve for the future. It can help better the delivery. But what about the banking sector, which has so much self-inflicted woes of bad assets, being saddled with huge NPAs? Can technology solve for all the problems? One has to really understand this. Joining me now is Ajay Shah, who is the partner for financial services and TMT Investment Banking Advisory for EY India. Ajay, thank you for talking to us and welcome to our
My
newsroom.
pleasure.
I would really want to understand from you that, what role can technology really play in transforming the trajectory of Indian banking?
Banking per se or financial services is undergoing a massive transformation. In India, originally, banking was all about how many branches you have and how you were expanding into the branches. But as literacy is going up, as the demographics of the country are changing, it's more and more penetration is getting in through technology and through internet. A lot of urban population is now rarely visiting the branches, and most of the work is happening through internet banking. Banks are also using a lot of AI, artificial intelligence, for marketing, for acquiring new customers, for selling different products to the existing customers, and all of that is enabled through technology. So technology is becoming important, more and more important in this space.
What about the banks, really, which are saddled with so much of bad debt and NPAs that really are the self-inflicted woes of the Indian banking system? Can technology be the panacea for the Indian banking space for that?
So that is a slightly tricky question, because if there are NPAs or if there are assets that have gone bad, the very little technology can do to solve. Technology would be more futuristic to try and use the metrics, which is so that it helps from a right lending perspective, doing interlinking of a lot of your backgrounds, which will help you from a future lending perspective, or ensuring that right customers are with the bank.
Sure.
But for the past, for the NPAs, for the kind of bad assets that banks have or the institutions may have, those would happen differently, and there is a very little edge that technology can give on those.
On these areas. So do you think technology is being used or bandied around loosely by some banks or by some entities to also perk up valuation when we talk about deals?
Most of these technology conversations that banks or NBFCs do are more on futuristic, to say how is it transforming my business, how am I mining the customer better, how am I acquiring the customer better, and how am I strengthening my processes. Because a lot of things like immediate lending, giving 3-minute loan, whatever, all of that is not possible without technology. So it'll be more to do with futuristic businesses rather than using it to say how does it help for my past. It's not that it cannot help for the past. Obviously, it gives you far better lever. It helps you to understand the problem cases far better with lot more information or AI tools. But what it can do from a futuristic or growth perspective would be very different, and that's what most companies talk about.
And are there like some global or local playbooks that one can follow or see here?
Right. So obviously, I cannot talk about specific transactions, but just in terms of general, if you were to look at, let's take Alibaba as an example. Alibaba has a lot of financial services investment. They own a significant stake in CICC, which is a Chinese
International Capital Group. Yeah.
Correct. Or you look at Paytm, which is in a similar financial services field. They're doing a lot of the stuff that earlier banks used to do from a new age perspective. Those are the kind of areas where there is a very good crossover between technology and banking, or financial services and technology. Going forward, we will see a lot more transactions, lot more use. Today, most of the financial services firms, be it banks, be it NBFCs, have a huge line item of technology spend. A lot of these companies are licensing newer technologies, are investing into making their technology strong. From two perspectives: one, they can use artificial intelligence and blockchain technologies from a growth perspective, and second is strengthening the data privacy. For both angles, the spend is constantly going up, and that's something which is a trend that you will continue to see going forward.
In the last 15 years, banks have achieved a stable growth in assets at 8.46%, relying on a steady increase in deposits and credit. Business has been easy. Saving rates in India, a proportion of the GDP, has fallen in the last years to 30.5%, is still one of the highest in the world. And yet, the innovation such as payments bank, digital wallets, and India Stack has been steadily eating away the bank's share of deposits. Deposits grew at 17.8% per annum between FY06 to FY12 and at 5.6% per annum between FY12 and FY19. And there's a strong desire among banks to upend the playbook of stable growth and look towards exponential growth. It is one of the areas that technology has delivered across industries, from mobility to real estate to financial services. However, the challenges in the banking sector are systemic. Yes Bank, for example, is plagued with a host of challenges: rise in NPAs, low provision coverage, trust deficit, quality of loan book, and subdued growth in credit. Many of the challenges are a sector-wide issue. For example, NPAs in scheduled commercial banks has touched Rs 17.56 lakh crore in FY19. Lastly, and while technology can overcome challenges in future, banks will really have to take a hard look at their past and solve their missteps. And as Taleb puts it, the real world is much more non-linear than we imagine it to be. A technology input does not necessarily guarantee a transformational output. This is a wrap on Mint Insight. Till the time we see you, goodbye and good luck, and enjoy the festive season.